At 2 a.m., in a quiet office tower with the lights still on, a handful of unelected officials can move more money than any parliament, any president, any billionaire on earth. They don't need armies. They don't pass laws. They don't campaign. They adjust a number. 0.25%. 0.5%. Sometimes less. And within minutes, currencies shift. Stock markets reprice. Governments rethink budgets. Corporations cancel projects. Mortgage payments change. Entire countries feel richer or poorer. This is the uncomfortable truth: central banks do not just manage money. They shape reality. And the real power they hold isn't the one most people argue about. It's not just interest rates. It's not just money printing. It's something quieter. Something structural. And almost no one talks about it. Right now, this matters more than it has in decades. Inflation surged. Rates climbed at the fastest pace in a generation. Debt levels sit at historic highs. Governments are running deficits they can't politically close. Markets hang on every word from central bank chairs as if they're decoding prophecy. You've seen the headlines. The Fed signals pause. The ECB hints at tightening. Markets rally on dovish tone. It feels theatrical. Dramatic. Almost absurd. Why should a few carefully chosen sentences move trillions of dollars? Because central banks don't just influence markets. They define the boundaries inside which everyone else must operate. To understand that, we need to rewind. Once upon a time, banking was simple. Gold sat in vaults. Paper notes represented claims on that gold. If you wanted stability, you needed metal. Central banks existed, but their role was narrower. They were lenders of last resort. Guardians of convertibility. Managers of panic. Then the gold link broke, its collateral for the entire financial system. And this is where the math starts to matter. Debt only works if it grows slower than the systems supporting it. Or if the cost of servicing it stays low. For decades, we got both. Interest rates fell. Globalization boosted growth. Inflation stayed muted. Debt became cheap. So cheap that borrowing felt responsible. Governments borrowed to stimulate growth. Corporations borrowed to buy back stock. Households borrowed to access lifestyle sooner. And markets rewarded it. Low rates meant higher asset prices. Higher asset prices justified more borrowing. More borrowing pushed growth forward. A self-reinforcing loop. Debt stopped looking dangerous. It started looking essential. Then something subtle happened. The system crossed a threshold. At high enough levels, debt stops being a tool. And starts being a constraint. When debt is low, you borrow to grow. When debt is high, you borrow to survive. That's a different dynamic. Interest payments become non-negotiable. Budgets harden. Policy options shrink. This is where debt becomes politically sensitive. Raising rates becomes painful. Cutting spending becomes explosive. Letting inflation run becomes tempting. And markets know this. They understand the incentives better than most voters ever will. Which brings us to the hidden mechanism. Debt is treated as an asset only as long as belief holds. Belief that payments will arrive. Belief that inflation won't erase value. Belief that the issuer won't change the rules. The moment that belief weakens, debt transforms instantly. From safe asset to risk. That transformation doesn't announce itself. It shows up quietly. Yields creep higher. Demand softens. Currencies wobble. Suddenly, debt that was considered risk-free needs explanation. Governments respond with reassurance. The debt is sustainable. Our fundamentals are strong. We have tools. Markets listen politely. Then they check the numbers. They issue bonds to finance deficits. Those bonds must be absorbed by markets. If rates are high, borrowing becomes expensive. Budgets strain. Debt service consumes tax revenue. Political pressure rises. If rates are low, borrowing feels manageable. Deficits expand quietly. Debt grows. So central banks, by setting the baseline rate, indirectly shape fiscal space. They don't vote on spending bills. But they determine how painful those bills become. That's not a side effect. It's structural. Now layer in something even more subtle. After the 2008 financial crisis, central banks went beyond rate adjustments. They began buying assets directly. Quantitative easing. Instead of just influencing short-term rates, they purchase long-term government bonds, mortgage-backed securities, sometimes even corporate debt. They expanded their balance sheets from billions to trillions. In the United States, the Federal Reserve's balance sheet grew from under $1 trillion before 2008 to nearly $9 trillion at its peak. That wasn't just liquidity support. It was market architecture. By buying long-term bonds, central banks suppressed long-term yields. Lower yields forced investors outward, into riskier assets, into equities, into emerging markets, into speculative ventures. Capital didn't disappear. It migrated. And asset prices inflated. Home values rose. Stock markets soared. Tech valuations stretched. It felt like prosperity. But here's the uncomfortable math. When central banks suppress yields, they compress risk premiums. Investors earn less for taking risk. To maintain returns, they take more of it. Leverage increases. Duration extends. Speculation intensifies. The system becomes more sensitive to rate changes. And when rates rise quickly, as they did recently, the impact is nonlinear. Bond prices fall sharply. Banks holding long-duration assets face losses. Governments refinance at higher costs. Mortgage payments reset upward. Equity valuations compress. All because the baseline shifted. Publicly, central banks speak about inflation targets. 2%. Price stability. Maximum employment. Privately, markets understand something else. Central banks cannot allow systemic collapse. This belief is known, informally, as the central bank put. If markets fall far enough, policymakers will step in. Cut rates. Provide liquidity. Stabilize conditions. That expectation changes behavior. Investors take risk, assuming downside protection. Governments borrow, assuming accommodative policy. Corporations leverage up, assuming refinancing will be available. The hidden power isn't just in action. It's in expectation. And expectations shape incentives. Consider this irony. Central banks are tasked with controlling inflation and maintaining stability. But prolonged low rates inflate asset prices. Asset inflation widens inequality. Inequality creates political instability. Political instability pressures central banks. The cycle feeds itself. Now zoom out globally. The US dollar remains the dominant reserve currency. Many countries borrow in dollars. Global trade is priced in dollars. When the Federal Reserve raises rates, the dollar strengthens. Capital flows toward higher yields. Emerging markets experience capital outflows. Their currencies weaken. Dollar-denominated debt becomes harder to service. A rate hike in Washington tightens conditions in Jakarta, Sao Paulo, Nairobi. No vote. No treaty. Just interest rate differentials. That is structural power. And it's rarely framed that way. We're told central banks are technocratic, independent, data-driven. And often they are. But independence is not neutrality. Policy choices distribute pain. Higher rates tame inflation. They also increase unemployment. They slow housing. They pressure small businesses more than large ones. They protect savers. They hurt borrowers. There is no painless setting. Every basis point has winners and losers. Yet central bank communication presents decisions as purely economic calibration. As if the dial simply aligns with natural law. But the dial shapes the law. Now let's examine the deeper mechanism no one talks about. Debt sustainability. Governments carry enormous debt loads. In many advanced economies, debt to GDP ratios exceed 100%. Servicing that debt depends on the interest rate growth differential. If growth exceeds interest costs, debt can stabilize. If interest costs exceed growth, debt compounds. Central banks influence the differential directly. Keep rates below nominal growth, and debt burdens shrink relative to the economy. Allow rates to exceed growth for too long, and fiscal strain intensifies. So central banks are not just inflation managers. They are silent partners in sovereign solvency. And here's the tension. Raise rates too aggressively, and you risk financial instability and fiscal stress. Keep rates too low for too long, and you risk inflation and asset bubbles. There is no stable equilibrium. Only trade-offs. Markets sense this. That's why forward guidance matters. That's why a single sentence in a press conference can move trillions. Because investors are constantly recalculating, how far can the central bank push? Where's the pain threshold? Who will they protect? The hidden power lies in defining the threshold. And thresholds are political, even when presented as technical. Over decades, central banks have accumulated credibility. Through crisis management. Through inflation targeting. Through coordinated action. But credibility is fragile. If inflation remains elevated while rates stay low, trust erodes. If unemployment surges because of aggressive tightening, political backlash grows. If financial institutions fail despite assurances, faith weakens. Trust is their real currency. Without it, policy loses traction. Here's the paradox. Central banks must appear powerful enough to anchor expectations, yet humble enough to avoid panic, decisive enough to signal control, flexible enough to adapt. Too much confidence can spook markets. Too little can destabilize them. It is theater and engineering combined. Now imagine a future where debt levels continue rising. Demographics slow growth. Climate transitions require massive investment. Geopolitical tensions fragment trade. The pressure on fiscal budgets intensifies. Who absorbs that strain? Taxpayers? Bondholders? Currency holders through inflation? Central banks sit at the crossroads. They can monetize debt. They can suppress yields. They can prioritize price stability. But they cannot eliminate trade-offs. And the more dependent the system becomes on low rates and abundant liquidity, the more disruptive normalization becomes. That's the hidden vulnerability. For over a decade, markets operated in an environment of suppressed volatility, cheap money, reliable intervention. Risk models calibrated to calm seas. Then inflation surged. Rates jumped. Bond markets experienced their worst losses in decades. Banks exposed to long-duration assets faltered. Not because central banks failed to act, but because the system had internalized their past actions. When gravity changed, structures built for low gravity cracked. So what is the hidden power behind central banks? It isn't just rate setting. It isn't just money creation.